Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The economy grew by just 0.2% in the 3 months to the end of December, with higher interest rates affecting household spending. The annual rate of growth for 2023 was 1.5%, slowing from 2.1% 3 months earlier. Carlos Cacho is Jarden Australia's chief economist. Carlos, welcome back to Fear and Greed.
Thanks for having me back, Sean.
What do you make of the results yesterday? 0.2%. Was it kind of what you were expecting?
Yeah, look, it's a soft GDP figure, but it's broadly in line with what the market and the RBA were penciling in. Both consensus of economists and the RBA thought we're going to have GDP around 1.5% to end 2023. So we were bang on that. But it's certainly, not a strong reading, and we have seen it steadily weaken through the year. That's really what you'd expect. The RBA is trying to, in their words, kind of get a better balance between demand and supply, and soft growth is the outcome of those hikes and of the RBA trying to bring inflation down.
Was the story yesterday households? Because there wasn't much growth amongst consumption.
Yeah, consumption does remain very weak. It was just 0.1% on the quarter. That said, it did pick up a little bit from September. September was negative. In terms of what drove that, it was really a pullback in discretionary spending. So households pulling back on things like spending out at restaurants and hotels, spending on clothing, and also tobacco, given you had a big increase in the excise in September, and then purchasing of vehicles and spending more on essentials like electricity and rent. Outside of the consumer, business investment was actually okay and has actually been holding up pretty well recently. So that's kind of like a bit of a bright spot. And the public sector remains a really key source of growth for the economy. And it's become much more important over recent years, contributing almost a third of overall domestic demand.
So let's talk about some of those things that we hear the Reserve Bank talking about and the need to change. Productivity, where's that sit?
Look, it picked up a bit in the quarter, albeit it was mostly driven by lower hours worked. So essentially the way the ABS measures productivity and the GDP growth is how much have we produced divided by how many hours we used to produce that. And so you can either have productivity move because we've produced more stuff or because we've worked more or less hours. And in this case, it was mostly because we worked less hours as employers cut back on their staff hours. And so we did see an improvement in productivity. That said, it remains relatively low. The other key thing related to that the RBA and the market has been focusing on is something called unit labour costs, which essentially measures what's the cost of labour required to produce a unit of output in the economy. And unfortunately the news was less positive, with unit labour costs remaining, continuing to grow at kind of mid to high single digits, so a bit over 6% year on year, which suggests it's still going to be pretty challenging to get services inflation to come back sustainably within the RBA's 2 to 3% target.
Stay with me, Carlos. We'll be back in a minute. I'm speaking to Carlos Cacho, Chief Economist at Jarden Australia. What about the whole idea of a per capita recession? What did yesterday's numbers tell us about that?
Well, it's continuing we've had population growth running at about 2.5% and GDP is running at 1.5%. So we've had another quarter of per capita recession. I think that's not a surprise to anyone based on this data. I think, the per capita recession is, it's a good headline, but I think it's not a big concern for the RBA. And importantly, I think one thing that's worth pointing out with that migration is it has been supporting spending, quite a bit. Yes, spending's weak, but without that immigration, it would be even weaker. So it is a bit of a drag, but I think the per capita recession, in my view, is a bit more of a headline grabber than a real concern for the RBA.
You are talking to a media outlet here, you know that. We like those headlines. What about the savings rate?
Look, the savings rate picked up a little bit. It's still very, very low. X the last couple of quarters, it would be the lowest we'd seen since before the GFC at about 3%. The reason it picked up in December is we saw slightly stronger disposable income growth. That was most driven by taxes. So we saw a modest fall in income tax just because of the timing of when people were filing their tax returns. But essentially, the savings rate's still quite low. However, it's important to remember that's the rate of savings today in this quarter. It's not the stock of savings. And if we actually look at the stock of excess savings households built up through COVID, there's still a lot of them there. So people are still slowly working through those savings. We estimate estimate there's still over $200 billion of them. Of course, those are not evenly distributed across all households. Some have a lot, some have largely run them down. But the excess savings that have been built up are still quite solid. And in our view, you should continue to provide a bit of a backstop for consumption over the year ahead.
Okay, so they kind of act like a shock absorber.
Yeah, for those who have them, they're able to maintain their consumption at a higher level, or meet their mortgage repayments out of those excess savings. Now, again, of course, not everyone has them, and in particular, we see that across age groups is where we see the biggest divide there, where your older Australians, 50 plus, have a lot of excess savings, and your younger, and particularly those that kind of core young families just starting out in their, buying their first home, 30 to 40-year-olds, don't have much excess savings left at all.
Okay, so what's all this mean? I mean, the economy obviously was slowing towards the end of next year, but not going backwards. It was still growing, just not as fast as it was earlier in the year. What happens next? I mean, this current quarter that we're in, is it likely that it's going to keep that trajectory, which means we could end up going backwards? Or do you think now that interest rates have more or less stabilised, that'll change things? What's your forecast?
I think things are going to remain fairly soggy in the near term, but I think there's a couple of kind of green shoots we're seeing on the consumer side that are worth pointing out. It does look like we've probably seen the worst of the falls in the kind of weakness in disposable income in both nominal and real terms. So importantly, in yesterday's data, real disposable incomes were no longer going backwards. So people aren't losing out to inflation in aggregate anymore. That's a big positive. Looking forward, we do expect that's going to pick up between no more rate hikes, potentially some cuts later this year in 2025, and the stage 3 tax cuts coming through. You have the housing market has continued to do well. That's supporting household wealth. That's seeing housing turnover pick up. And that usually drives a bit of an increase in spending as people are feeling better off. And, that, if anything, the housing market has actually accelerated in early 2024. So I think that's going to be a bit of a tailwind. If we look at things like consumer confidence, those surveys have also appear to have troughed and are improving. They're still weak. They're still at a very low level. But it does kind of, if we look across a couple of these things, it does look like the worst, maybe behind the consumer, and that the outlook might start improving from here. So still challenging and still tough conditions, but I think it does seem like things may get a little bit better as we move through 2024, particularly as we get to the second half of the year and we get that support from the stage 3 tax cuts coming through, which is going to be about 1% of disposable income to households.
Okay, so I wanted to get there. I mean, so we may be coming in for a soft landing. The Reserve Bank and government may land the economy and not go into recession. That's kind of where we're thinking at the moment. Correct me if I'm wrong there. What about when those tax cuts come in, and what about rate cuts later in the year?
Look, our view is rate cuts are probably going to be a little bit slower to come through than most other market participants. We don't have them penciled in until February 2025. The main reason is we still just think the services components of inflation that the RBA is really worried about are going to be quite sticky. We've kind of seen that through things, things like rents, insurance are still remaining relatively elevated. The weakness in demand and the weakness in CPI we saw last week in the monthly data is definitely a positive in getting that better balance. And so maybe you could see a cut as early as November, but we think kind of barring a real rapid deterioration in the labour market, we'll probably see the RBA remain on hold for a little bit longer than people expect.
Carlos, you've been an economist for a while. You're also a bank analyst, a very, very busy man. How do you get your head across the national accounts? That is a massive document. And I've just asked you a bunch of questions, which I've gone off and researched. How do you get your head around it?
You just got to be in the data. And I think the best way to learn is just to actually play around with the data and look at it. We've got a massive spreadsheet set up with just about every line item there, and you kind of go through it line by line, have a look around it. After a couple of years, you kind of start to understand it. But there's some of these economic releases, especially the ones that only come around once a quarter or once a year, that take quite a while to really understand. So it's just, I guess, practice makes perfect, hopefully, eventually. But you're always learning something new. You always see someone post a good chart online or get a good question from a client and dig into a little section you might not have unearthed before.
Fair enough. Carlos, thank you for talking to Fear and Greed.
Thanks for having me, Sean.
That was Carlos Cacho, Chief Economist at Jarden, Australia. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.